For decades, Americans have chased the same dream. Move somewhere better, lower taxes, better weather, more space, a higher quality of life. And for a long time, that dream made sense. But something is shifting, quietly, slowly, and in ways that most people don't see until it's already too late. Because across this country, certain states are entering a new kind of financial pressure zone. Not because of one bad policy, not because of one bad storm, but because of three forces colliding at exactly the same time: insurance, taxes, and climate pressure. Individually, each one is manageable. People adjust, people adapt. That's what they've always done. But together, they're creating something far more dangerous than any single problem ever could. A slow, invisible squeeze on the cost of simply staying put. And by the time most people realize what's happening to them, escaping cheaply is no longer an option. This isn't about politics. This isn't about which party runs which state. This is about a pattern, a chain reaction, one that's already unfolding in 10 states right now. And by the end of this, one thing is going to become very clear. This is no longer a future problem. It's already here. Let's start at number 10, Arizona. Picture it. Sunshine every single day. A booming job market. Relatively low taxes compared to coastal states. For years, Arizona was one of the most attractive relocation destinations in the entire country. People left California by the thousands. They came looking for space, affordability, and a simpler life. And on the surface, they found it. But beneath that image, something else has been building. Something that doesn't show up in the real estate listings or the relocation guides. Extreme heat is no longer just an inconvenience in Arizona. It's an operational cost. Summer energy bills in Phoenix can run hundreds of dollars per month. Cooling systems work harder, fail faster, and cost more to replace. Infrastructure built for a different climate is being strained in ways that nobody fully accounted for. Then there's water. The Colorado River, which supplies water to a significant portion of Arizona's population, has been running at historically low levels for years. And when water becomes scarce, everything built around it becomes vulnerable. Agriculture, development, long-term habitability. Insurance models are quietly beginning to factor in environmental stress. Not dramatically, not overnight, but the trajectory is there. The illusion is affordability. The reality is a rising baseline cost just to maintain normal daily life. And the question that more and more Arizona residents are starting to ask is a simple one. How long can a place stay cheap when survival costs keep climbing? Moving up to number 9, Colorado. Colorado offers something genuinely rare. Stunning natural beauty. An outdoor lifestyle that's hard to replicate. A sense that you're living somewhere that actually matters. And people have responded. Population growth has been consistent for years. Professionals, families, remote workers, all drawn to that combination of landscape and quality of life. But that beauty comes with a price tag that's getting harder to ignore. Wildfires have become a permanent feature of Colorado's reality. Not an occasional crisis, a recurring season. And when wildfires become predictable, insurance companies start doing math. They raise premiums in high-risk zones. Some pull back coverage entirely. And suddenly, the dream home on the edge of the mountains comes with an annual insurance bill that reshapes the entire financial picture. Property values in desirable areas have climbed faster than incomes for many residents. What once felt like a balanced, livable lifestyle is now becoming financially stretched for anyone who didn't get in early enough. The lifestyle is still beautiful. The question is whether the cost of maintaining access to that lifestyle is still worth what it's demanding in return. Number 8, Nevada. For a long time, Nevada's pitch was simple and powerful. No state income tax, warm weather, a business-friendly environment. Come here, keep more of what you earn. And it worked. Las Vegas grew into one of the fastest expanding metro areas in the country. Reno transformed. People and businesses relocated in large numbers, drawn by that core promise of financial freedom. But rapid growth has a way of eroding the very advantages that caused it. Infrastructure in Nevada has struggled to keep pace with population expansion. Roads, water systems, housing supply. The gap between demand and capacity has widened. And when infrastructure strains, costs shift. They don't disappear. They just move into different line items. Housing prices in key Nevada markets have risen dramatically. Insurance premiums, particularly in areas with fire risk or extreme heat exposure, are climbing. The tax advantage, which was the entire foundation of Nevada's appeal, is being quietly offset by higher costs in categories that don't show up in a simple tax comparison. The illusion is tax freedom. The reality is cost migration. And when those costs compound over time, the original advantage starts to dissolve into something far less attractive. Number 7. New York. New York doesn't break people suddenly. That's not how it works. It tightens. Slowly. Year after year. In ways that are easy to rationalize one at a time, until you step back and look at the total. High state and local taxes. Some of the highest property taxes in the nation in certain counties. Insurance costs that reflect both the age of the housing stock and the increasing climate exposure of coastal and flood-prone regions. Infrastructure that, in many parts of the state, is aging faster than it's being replaced. And a long-term demographic trend of residents quietly leaving for lower-cost alternatives, taking their tax base with them, which puts pressure on the state to fill the gap through other means. For many people, there is no single breaking point in New York. It's accumulation. It's the property tax bill that went up again. It's the insurance renewal that came in higher than last year. It's the calculation you run one afternoon and suddenly realize doesn't add up the way it used to. By the time most people decide to leave New York, the financial damage has already compounded for years. The cost of waiting is real. It's just invisible until it isn't. Halfway through this list, and a pattern is already becoming impossible to ignore. These aren't random, isolated situations. They're not just bad luck in different locations. They're variations of the same underlying dynamic playing out across different geographies. Environmental pressure increases. Financial systems respond by raising costs or withdrawing entirely. And the people who live there absorb the difference, whether they're aware of it or not. Different states, different specific risks, same trajectory. And that trajectory is accelerating. Number 6. Illinois. Illinois presents a different kind of pressure. It's not primarily climate driving the problem here. It's structural. It's financial architecture built over decades that is now becoming very difficult to sustain. Illinois has some of the highest property taxes in the country. And property taxes, unlike income taxes, don't flex with your financial situation. They come due regardless of whether you got a raise, regardless of whether the economy is strong, regardless of whether you're retired and living on a fixed income. The state has faced significant budget challenges and pension obligations for years, and those obligations don't disappear. They require ongoing revenue, which means the pressure on existing taxpayers doesn't ease. It persists. The question in Illinois isn't simply "0." Most people already know it's expensive. The deeper question, the one that keeps financially thoughtful residents up at night, is, will it keep getting worse? Because a place can be expensive and still be worth it, if you can predict what you're walking into. The real danger is an expense trajectory that has no clear ceiling. Number 5. Louisiana. Louisiana shows what happens when the system doesn't just strain. It breaks. Frequent hurricane activity. Persistent flood risk. Coastal erosion, that is, in some areas, literally reducing the amount of land that exists. These are not theoretical future risks in Louisiana. They are the current operating reality, and insurance companies have responded accordingly. Multiple major insurers have withdrawn from the Louisiana market entirely in recent years. When that happens, homeowners face a stark choice: turn to the state's insurer of last resort, which comes with higher premiums and more limited coverage, or operate without adequate protection. When insurance disappears from a market, it sets off a chain reaction. Mortgage lenders require coverage. Without affordable private coverage, financing becomes complicated. Property values in high-risk areas become unpredictable. Entire communities begin to feel the financial ground shifting beneath them. Louisiana isn't a warning about what could happen. It's an example of what already has. Number 4. Texas. Texas has been one of the most powerful relocation stories of the last decade. No state income tax, business-friendly policies, a booming economy, cities growing at remarkable speed. The pitch was freedom, growth, opportunity. And for many people, especially those coming from high-tax coastal states, Texas delivered on that pitch in real and meaningful ways. But the hidden layer of Texas costs is a story that doesn't make it into the relocation brochures. Property taxes in Texas are among the highest in the nation. And because the state relies heavily on property taxes instead of income taxes, the burden on homeowners is substantial and consistent. The tax freedom that attracted people is real. It just comes with a trade-off that isn't always made explicit up front. Insurance costs in Texas are rising, particularly in areas exposed to hurricane risk, flooding, and the kind of severe weather events that have become more frequent and more destructive. The 2021 winter storm alone reshaped how people and institutions think about risk in the state. The illusion is low cost. The reality is complexity. And for many Texas residents, when they add up property taxes, rising insurance, and the cost of weathering an increasingly volatile climate, the total number is significantly higher than they expected when they made the move. Number 3. Florida. Florida is no longer a future warning. It is a current, documented, undeniable example of what happens when all three of these pressures, insurance, taxes, and climate, converge on the same place at the same time. Insurance premiums in Florida have surged to levels that have shocked even longtime residents. Several major national insurers have pulled out of the Florida market entirely, leaving homeowners scrambling for coverage through the state-backed insurer of last resort, Citizens Property Insurance, which has been stretched to its operational limits. Some homeowners in high-risk areas are simply being dropped. No renewal. No alternative offered. Just a letter and a deadline. Climate risks in Florida are not speculative. Sea level rise is measurable and already affecting low-lying properties. Hurricane intensity has increased. Flooding events that were once rare are becoming more routine. What was built over decades as one of the most desirable retirement destinations in the world is now, for a growing number of residents, becoming financially unsustainable, not because they want to leave, but because the cost of staying is no longer something they can reliably plan around. Number 2. California. California is, in many ways, the most complex case on this list, because the pressures here aren't just intense, they're layered. State income taxes among the highest in the nation. Property values that have priced out entire generations of would-be homeowners in major metro areas. Wildfire risk that has moved from a regional concern to a statewide reality, with entire communities destroyed in recent years. Insurance companies have responded to California's wildfire exposure the same way they've responded to similar risks elsewhere. They've raised premiums dramatically in high-risk areas, and in some cases, they've stopped offering coverage in those areas entirely. State Farm, Allstate, names that represent the foundation of American insurance, have taken significant steps back from the California market. Regulatory complexity adds friction to every aspect of owning property, building, or adapting to changing conditions. And the cost of living in California's major cities has reached a point where even well-compensated professionals are running the numbers and finding they don't work. Individually, any one of these factors is manageable. People build lives around difficult conditions all the time. But California is asking its residents to absorb all of them simultaneously. And the outbound migration numbers suggest that more and more people are reaching a point where the math simply stops making sense. Number 1, Hawaii. Hawaii is beautiful in a way that is almost impossible to overstate. And that beauty is real. It isn't marketing. It isn't an illusion. But beauty and financial sustainability are not the same thing. And Hawaii represents the most extreme version of everything this list has been building toward. The isolation that makes Hawaii unique also makes it uniquely vulnerable. Nearly everything is imported: food, materials, energy. The cost of goods is significantly higher than on the mainland, and that gap isn't narrowing. It's structural. Housing costs in Hawaii are among the highest in the United States. Not just for buying, for renting, for existing. The cost of simply being there, day after day, is relentless in a way that doesn't ease with time. Climate exposure is real and increasing. Certain coastal areas are already dealing with erosion and flooding that threatens both property and infrastructure. Insurance options in vulnerable areas are limited and expensive, and unlike mainland states, where someone facing rising costs has the option to relocate to a neighboring state with lower costs, in Hawaii, every alternative requires a flight. When costs rise in an isolated system, there are fewer escape routes, fewer alternatives, fewer pressure valves. And for working-class and middle-class Hawaii residents, the people who actually built and maintain the infrastructure that makes the islands function, the financial reality is becoming increasingly difficult to navigate. So what do you do with all of this? The real takeaway isn't that these states are unlivable, at least not yet. People are building lives in every single one of them. People are raising families, building businesses, finding community and meaning and home. The takeaway is that the margin for error is shrinking. In all of these places, the cost of staying is less predictable than it used to be. Insurance is less reliable. Climate pressure is less theoretical. And the gap between the life people planned for and the financial reality they're navigating is widening in ways that compound quietly over time. The real risk isn't where you live today. It's the assumption that tomorrow will look like today. Because once this shift becomes obvious, once the insurance letter arrives, once the tax assessment lands, once the storm hits and the claim is denied, the exit is no longer strategic. It's reactive. And reactive decisions, made under financial pressure, almost never lead where you hope to go. The people who navigate this well are the ones who see the pattern before it fully arrives, not after.